Malbang, ladies and gentlemen. I'm Hiral Datia. We have with us Dr. Rupa Regenitsure, Group Chief Economist at L&T Financial Holdings, joining in. Welcome to the show, Dr. Rupa, and always a pleasure to speak to you and get insights from you. Dr. Rupa, let's start firstly with regards to where the growth side of India is concerned. Clearly, we are looking at the fourth quarter FY22 GDP numbers. What's the sense that you're picking up?
There is certainly higher degree of optimism because we had seen that last time when we had spoken, there was this Omicron scare and we faced a lot of uncertainty. But after that, the earnings and, if you go by the select leading indicators, both for agriculture as well as non-agriculture sector, we had seen some good growth momentum. Unfortunately, there were some headwinds in the form of, this Russia-Ukraine war and China's zero COVID policy and US Fed rate hikes, our own domestic monetary policy tightening, etc. So, but point is that nothing was unexpected. I think the country appears to be adjusting to new normal. But if you ask me, the probability of high impact events has increased because of a lot of economic uncertainty in the external world. But compared to our peers, I feel India definitely is doing well.
Right. So overall, if you see in terms of the FY23 GDP forecast as well, what's the sense that you're picking up? Because 8-9% is what everyone was thinking of earlier. Now, a lot of cuts that have started to come in as well because commodity prices are elevated. Global growth as well is something which is slowing. There is monetary policy tightening across most markets. So do you think all of these factors could weigh on the growth forecast, because of which we will have to downsize?
It is too early, I feel. Definitely, there are, as I said earlier, many headwinds to our growth trajectory. But, there could be some positive surprises also in the form of good agricultural year and, the kind of growth momentum we are seeing in exports. Because, on the one hand, Ukraine-Russia war has created a lot of stresses from the supply side. There is again supply side disruption, etc. But it has also opened up market for India's exportables from rest of the world. So, the net balancing impact one has to see sometime midway, August, September would be a better months to have undertake any forecasting exercise for year as a whole. Given the degree of uncertainty at this stage, I feel it is better if we avoid getting into any projections.
Right. And overall, if you see in terms of where manufacturing is concerned, do you think there is a possibility of likely margin pressure that we could have seen in the fourth quarter of FY22?
Definitely, because the prices of raw materials have gone up across the board. And, of course, Government of India is trying to countervail that by reducing, import duties on select items, etc. But then, that is just a tip of the iceberg. I mean, if you see the supply chain disruptions and the kind of shortages that have emerged, across the board, there will be increase in the cost of production. And we are seeing it in many surveys also, such as IIM Ahmedabad survey on business inflation expectations, etc. I think the manufacturers' expectations of cost push inflation have gone up significantly in the fourth quarter.
Right. And overall, if you see in terms of, on contact services, the impact that Omicron variant has caused, do you think that would have been something which would be offset by government spendings and construction activity?
To some extent, yes. But point is that government also is working within many fiscal constraints. And the recent, example, the recent measures taken by the government to reduce, taxes on petrol and diesel, that also has implications for its earnings. And more than that, they are also providing additionally gas subsidy to poor people. That will also impact their revenue generation. And more than that, I think they will have to spend higher amount on fertilizer subsidy. So I only wish that these additional spendings because of external headwind should not come in the way of their proposed plan of capex, which all of us felt at that time would help generate employment. But as I said, government also has to balance between different actions, and it is working under severe fiscal constraints.
Right. And overall, if you see, even on the inflation front, currently, if you go to see, yes, a lot of measures that the government have been taking, for example, cutting excise duty with regards to, fuel prices are concerned, that is something that they are looking at in order to tame the inflation down. What's the sense that you pick up? How are you expecting the inflation to pan out from here on? Because, food prices are higher, fuel prices are higher. And if that continues, that's something which could be a major concern on the growth story.
Absolutely. Government's measures, central government has reduced excise duty. In response to that, state governments also have reduced VAT, etc. But it will not, people are expecting inflation to go down by 20, 25 bips, etc. because of that. But, we may see a slightly benign, not benign, but some easing of CPI inflation in month of May because of base effect, etc. But I don't think, overall inflationary concerns will get reduced because of that. Because point is that fuel prices have been going up across the globe, and because of these war-induced disruption and China's zero COVID policy, because China has shut down more than 40% of its economy, and it's a global manufacturing hub. So, entire world is now facing the shortages of key raw materials and intermediate goods. So, but there are cost push pressures across the globe, and India can't remain insulated. So, and because of heat wave and all, which was quite exceptional this year, we have seen prices of many vegetables and fruits also have escalated. So, point is that, and there will be indirect effect, the cascading effect of earlier, elevated fuel prices for a significantly long period of time. So, factoring in all these elements, I don't think, anybody should attempt to reduce their inflationary projections at this point of time. I think inflation will surprise on the upside rather than on downside, despite these measures.
Right. And overall, in the recent report that came out from the RBI as well, the government transfer has fallen sharply to almost around 30,300 odd crores. Do you think that's something which might impact the budget math of the government as well? And that could be a concerning point?
I personally feel that this is again not a surprise, because we have seen that, see, Reserve Bank of India today has to take care of many things. They have to safeguard the value of our currency. Of course, they have created good forex buffers, etc. But point is that they also have to think in terms of creating a good contingency fund for to take care of any exceptional event. So they, as per the Bimal Jalan committee's recommendation, they have to maintain that risk buffer at 5.50% level. So after providing for that, they had to reduce this transfer from last year's, say, 90,000 crore to this year's 30,000 crore. But then that is essential to protect India's macroeconomic and financial stability. So also they have to, provide for revaluation of reserves, which they have to do at the end of every week and every month and every quarter. And with this kind of volatility in exchange rates and prices, they have to make higher provisions there also. So I think, though it will impact government's fiscal mat to some extent, this is not a surprise. I'm sure that all central monetary authorities across the globe are now concentrating on creating and protecting their contingency funds.
Hmm. Right. And overall, if you see in terms of, how are you looking at it when the RBI has already taken a surprise rate hike, in between? How are you viewing that aspect of it?
See, as I have said in my write-ups as well as earlier interviews, it was not a surprise to us at all. While inflation was rising, that action at that point of time on 4th of May 2022 was triggered by the knowledge that US Fed, is going to raise rates quite aggressively, and that may have negative impact on capital inflows to emerging market economies, including India, and it would have created a lot of pressure on our rupee. If you see on that day, actually the value of rupee stabilized. So it was a very timely action. Also, it was, we should not look at that action in isolation, because even in a policy before that, in April policy, they had introduced standing deposit facility, which was a recommendation, one of the recommendations of Urjit Patel Committee on Inflation Targeting. And there they had said that SDF rate 40 bips higher than reverse repo rate. So in a way, they had given a clear signal of tightening in April policy itself. Here again, they raised the repo rate by 40 bips. So cumulatively, the rates were raised by 80 bips, and that is done in April and May. Plus, they raised the CRR by 0.5%, because CRR, is sucks liquidity from the system on a durable basis, and RBI no longer has to provide any interest payment to banks on that. So at this point of time, when the Reserve Bank of India's balance sheet is under pressure because of its sustained intervention in the forex markets and the fact that it has to create enough contingency funds, etc., that move on 4th May was very logical and timely.
Hmm. Right. So from here on, by how many basis points are you expecting rate hikes? Because in the Monetary Policy Committee meeting that were released recently, one of the members said another 100 basis point rate hike is warranted and expected to happen soon. So what are the timelines we should be working with, and what's the anticipation at your end?
See, as the majority of RBI's Monetary Policy Committee members have been saying, they will remain in data-driven mode. As I said, we are facing very high degree of economic uncertainty. And last time's move also was warranted because of the actions of global central banks. So RBI will continuously reassess the growth inflation dynamics. They will see, because growth is also still fragile. We are having a lot of problems on aggregate demand front. Demand has not picked up. If you see last a month's in the index of industrial production statistics, both consumer durables as well as consumer non-durable goods growth is still negative. So that is indicative of weaknesses, lingering weaknesses in aggregate demand. So Reserve Bank of India's actions will get governed more by, I think, what's happening across the globe, or the actions of the global central banks, rather than on a standalone basis.
Hmm.
Having said that, given the emerging inflation trajectory, and given my own expectations of what global central banks would do, I think expecting 75 bips to 100 bips of rate increases is reasonable. But in what combinations it will happen, and in what frequency it will happen, that will be data driven. We cannot say that definitely in June policy they will raise rates by 50 bips. No, I won't buy that argument. It all depends on various incremental data points that we will see before that, and the actions of global central banks.
Right.
Because now the concerns of
Hmm.
growth slowdown, I think, have also become quite serious.
Right. And overall, if you see in terms of, as we mentioned, that yes, the timings, everything will be pretty much data driven. But in case, hypothetically, if the rate hike happens in a short period, do you think it could have a major shock in the credit markets, spiking credit costs? And that's something which would actually hit the smaller companies as well as individual borrowers.
Definitely, any interest rate hike always, increases the indebtedness or the repayment burden. But point is that companies have enjoyed, benign interest rate environment for more than 2.5 years, and we are seeing that despite the fact that interest rates have started rising, because even before Reserve Bank of India undertook formal policy rate hikes, we had seen hardening of yields in the bond market, and widening of spreads, etc., over GSEC yields because of the expectations. But despite that, we are seeing growth in credit disbursements. So there is some kind of an optimism, and compared to pandemic years, actually now we are seeing good momentum in bank credit growth. So I feel that it's more than interest rates or the cost of capital. What will drive credit demand and growth is manufacturers' expectations of economic recovery, demand recovery, etc. And this need not, this will not act as a serious deterrent for that.
Right. And how are you seeing bond deals, pan out from here on? Do you think there could be pressure with regards to bond market, and yields could move higher from here on?
Yeah, but point is that as I said, there will be, given the backdrop of economic uncertainty, I expect it to rise more on the shorter end, where inflation concerns and RBI's actions, they will have more impact on the shorter end of the yield curve, and also within the duration of 3 to 5 years. But long-term yields, 7 to 10 years, may not see much impact.
Okay. And clearly, if you see in terms of the fiscal deficit as well, anticipation is yes, it will broaden, and the deficit would likely exceed the budgetary estimates as well. So, any thoughts on that front?
For me, widening of fiscal deficit per se will not pose any concern. But if Government of India continues with its capex push, then that will, give confidence to investors as well as domestic entrepreneurs, that the quality of fiscal spending is good, and it is actually helping, or acting as a stimulus for growth. So if fiscal deficit widens because of government's continued thrust on capex, then that need not be perceived as a negative thing. It will not be, downplayed even by the rating agencies. They will not take that negatively. But if we keep on increasing, if the government keeps on increasing only the revenue spending, and which it is doing for the right reasons now, because it has to give a subsidy to poor, because the way inflation is rising, but it is a tax on poor people. So government is helping them through subsidies, food subsidies, fertilizer subsidies, gas subsidies, etc., which according to me is fully justified and reasonable. So, but because of that, they should not reduce their proposed plans of capital spending. So if they continue with those plans, then I don't think, even if fiscal deficit widens, it will be viewed negatively either by investors or by domestic rating agencies or international rating agencies.
Right. And very lastly, Dr. Rupa, anything else that you think needs a highlight from an economy perspective that we need to watch out for that we've not spoken about?
See, I just want to tell you that there are two bright spots. One is that after a long gap, we have started seeing improvement in terms of trade for farmers. Even though they have to spend higher amount on fuels like diesel and kerosene, etc., they are getting very attractive mandi prices on major rabi crops. The mandi prices actually are ruling over and above a minimum support prices for important rabi crops like wheat, edible oils, etc. And that is directly benefiting farmers. Also, because of this war, many export markets have opened up for India. So if India and Ministry of Commerce is coming out with many attractive schemes to boost Indian exports. So I think if those efforts continue, then that will really help India's balance sheet, because it will give us good export earnings on a sustainable basis. And to that extent, it will, reduce the pressure on India's trade account, current account, etc. And also, Reserve Bank of India will have better forex buffers. So I think under any circumstances, government should not dilute its thrust on giving stimulus to exports, because we need sustainable earnings from exports going ahead. Another bright spot is that, again, Indian weather department has forecasted normal monsoon this year, not just in terms of quantum, but also distribution of rainfall. So if it pans out like that, then certainly it will give a good boost to overall demand, because even if agriculture's direct contribution to India's GDP is 14-15%, rural economy takes care of more than 50-55% of aggregate monetary demand. So I think, positive outlook on farmers' cash flows and exports. These two are bright spots, and I feel there should not be any policy-induced, disruptions to these two markets, because they will really help us, do better in FY23.
Right. So overall, a couple of things we need to watch out for as well. Yeah. Thank you, Dr. Rupa, so much for joining us on the show. As always, it's a pleasure to get your views and insights. Thank you. Stay safe and speak to you soon again.
Yeah, thank you. Thanks a lot.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.